Hello, everyone, and welcome. My name is Marcel. I'm part of the investor education team here at Scotia iTrade. I will be your host for today's session. Now, we'll walk through how cryptocurrencies work, how crypto ETFs are structured, and how investors are accessing this space through more traditional investment vehicles. We'll also explore how digital assets may fit within a broader portfolio, including their role, key characteristics, and how they interact with more traditional asset classes like stocks and bonds, so that way you can better assess where they fit within the evolving investment landscape. Now that we've set the stage, I'd like to introduce our speakers for today's session. First joining us is Pascal St-Jean, CEO of Coincheck Group and 3IQ Digital Asset Management. He has played a key role in expanding access to digital assets through regulated investment solutions, including crypto ETFs, and brings a global perspective on how the space is evolving. Now, also joining us is David De Pastena, who brings over 20 years of experience across client advice and institutional asset management. He specializes in portfolio construction and has worked closely with financial advisors to support disciplined investment approaches. Now, to kick things off, it'd be great to hear a bit about your backgrounds and the perspectives you bring to the space. Pascal, I'll start with you. Given your experience building digital asset platforms and crypto ETFs, can you share a bit about your role and how that shaped how you set the stage?
Thank you so much, and thank you for hosting this today. It's a pleasure to be here. I've been in the space for almost a decade now, and you can imagine when we started our adventure years ago, regulation wasn't clear, ETFs weren't here. The promise of the technology was always there, right? What can Bitcoin become? What can Ethereum and Solana? Well, Solana wasn't even out back then, but what can these layer one blockchains become? So since then, a lot has evolved. So today, Coincheck Group, we are a global, unified digital finance platform. We're providing sort of the bridging layers of custody, asset management, execution, and staking to institutions who want to enter the space. So think about banks, asset managers, large private clients, et cetera. So you can imagine, servicing those types of clients today was nowhere to be seen 7+ years ago. I'm also, like I said, dual CEO of 3IQ Digital Asset Management, which was born right here in Canada. And we help pioneer the industry here in Canada and at the same time work with the regulators to build a framework that today has been utilized by multiple other regulators globally. So a lot of what we've seen today in terms of ETFs that we're talking about globally, and what we're talking about specifically in this webinar, started right here in Canada. So Canada helped innovate not only ETFs in general, but crypto ETFs and products as well. And so, like I said, the biggest thing that I've seen, and that's right now more true than ever in 2025 and 2026, is 7-8 years ago it was what the promise of the technology versus now seeing the technology truly being implemented. I mean, putting price action aside and market volatility aside, it's really interesting to see the conversations that we're having with global institutions looking to adopt stable coins, tokenization, understanding what blockchain could bring to their business, and understanding where the future of finance lies for both retail and institutions globally. So at a high level, it's been a really fun ride over the past decade, and we're really excited about the next decade to come.
Thank you, Pascal. That's really helpful context. So David, let's bring you in here. Can you walk us through your background in portfolio construction and how that influences the way you think about incorporating newer or even emerging asset classes?
So you made me feel a little old with the 20+ years. And as you can tell, a little bit more facial hair from the picture that you can see there. And the markets have probably made that facial hair a little whiter. But I've had the privilege of consulting on about $100 billion of advisory assets, helping advisors optimize, so financial advisors in the world, optimize their investment models. And I also worked on our pools platform, which is a $9 billion platform. And I look at investing in a very simple way of I'm building as a good Canadian, we'll use a hockey analogy. I'm always looking at if I'm building a really good hockey team, I need a good defenseman, I need a good offenseman, some forwards, a goalie, a good coach. And portfolio construction is different than security selection. So the lens I always look at things as can I put these different things together that create a better outcome than what I had before? So if I'm adding something like crypto, and I'll be honest, I've been a skeptic of crypto for a very long time. And only recently, as I'm learning things from Pascal and running the numbers on adding it to a portfolio, that I've actually changed my mind. So I want to say that up front. But much like everybody else, I've been very skeptical. And the lens I look at things through is how does this add value on the margin if I add it to my portfolio? Does it increase my return? Does it reduce my risk, or does it give me income? And I'm always looking at non-traditional assets in that way, because there's a lot of other options we can pick from, and which we'll probably talk about today. So that's the lens I look at. Is it's one thing to do security selection, picking individual stocks or ETFs or bonds and funds and stuff. It's another thing to put those things together. And I think, especially in the people that are listening here, I want to elevate the conversation to think about portfolio construction and not just I'm going to pick the latest, greatest ETFs. That's the lens I look at things as. On a whole, are we creating wealth, and are we putting the right things together?
Definitely sets the stage nicely, David. Now, if we take a second and we zoom out a little bit, Pascal, when we do use the terms digital assets, how should we be thinking about that in an investment context?
That's a great question, and it's always where we start with the education side. You could imagine today is a little bit different than 4 or 5 years ago, when people used to say, "Hey, there's thousands of crypto projects out there," and they're associating crypto like if it's all the same. And just a bit like selecting stocks or selecting ETFs. Imagine saying, "Well, there's 10,000 ETFs out there. Are they all the same?" No, they serve different purposes. They're trying to solve different use cases. So we have to think at digital assets as 3 main buckets. And these main buckets is also where the trends in regulations are happening and the trends in institutional adoption are happening. So the first is blockchain infrastructure. And so when we talk about crypto or digital assets, most people refer to this to start at this point. Think of Bitcoin, Ethereum, Solana, XRP, hyperliquid. So essentially it's either layer 1 blockchains where essentially stable coins get built, tokenized assets get built on, or even decentralized financial applications get built on. And so those are primarily the assets we'll be talking about today when we're answering questions, and when David's talking about his analysis of portfolio construction. It's primarily in bucket 1. We're talking about infrastructure. Then we got to look at what's happening in the world. Well, in the end, this is infrastructure. This is technology. It's kind of the first time in history where the asset is also the technology. And so back in the day, if I was a fan of search engine technology and I wanted to invest in that trend, I'd be looking at who's out there. Well, Google was public. Today, for example, if I'm a fan of AI, I'd be looking at maybe the SpaceX IPO or be looking at the OpenAI IPO. But it's the first time in history where the technology is also the asset. And so you're not necessarily looking for a security. And so the technology enables a lot of things. The first is a lot of big trends that we're seeing. Stablecoins, which we'll talk about, those are also referred as digital assets, but they're primarily used as a form of payment. And I know they serve a lot more than just payment, but fundamentally think about it as a digital dollar, right? So different than a layer 1 blockchain. And the third is tokenized assets or digital assets. So I think what we're seeing globally, and it's happening both at the institutional level and at the retail level, is there's a bigger and bigger desire to diversify a portfolio, whether that's with alternative assets. And alternative assets, not all of them are fully liquid or fully retail accessible, or a little more complex to sign up to. You're starting to see some platforms give access to those, but they're few and far between and still complex. Crypto blockchain infrastructure enables the digitization of different types of real-world assets, whether they're existing funds, whether they're existing ETFs, or real estate, et cetera. Name it, it can be tokenized. And we can talk about how that all functions. But what that means, though, is that all of a sudden now everything sits on the same digital layer, transferable 24/7, exchangeable, in different geographies, and all settled on the same technology. So that's the power. So fundamentally, you have the power of the blockchain, which is a technology and an asset. So layer 1 blockchains, and then what they enable. So when you put all that together, that is the digital asset universe. But you got to think about it differently. There are tokens for payments. There are tokens that give you access to the underlying infrastructure, and then there are digital assets that are going to give you access to other types of existing investments, but in a digital form. So hopefully that gives an idea of the universe, so that as you start looking at how to incorporate these in a portfolio, you understand what you're investing in.
For sure, it's definitely a helpful way to frame it. Now, if we're building on that, how have crypto ETFs changed the way investors actually access these digital assets today?
Absolutely. So when we're talking about digital assets for this question, we'll primarily focus on the blockchain layer 1s, like I was saying, like Bitcoin, Solana, ETH, et cetera. So you can imagine that what ETFs have done, it's like taking a new asset class, but bringing it into a world where more people can access it today with the tools that exist. So my background has been in finance, but also in technology for over 30 years. And anytime there's a new disruption, whether it's the internet or AI or the mobile phone, et cetera, there's always the beginning curves where essentially the user interfaces aren't that great, right? The technology is promising, but the UI isn't that great, and it's really used by early adopters. And then all of a sudden, you have more companies that adopt it, more developers that join the community, and then all of a sudden, more people want to use it, and then more simpler, more integrated user interfaces get created. So think of an ETF like a user interface to simply access digital asset investing in a safe, simple, secure way. And one could say, well, what's the big deal about the ETF? Well, the ETF is also, a regulated security in many jurisdictions, including here in Canada. And so as soon as you get something that's accessible in an ETF format, it unlocks a whole bunch of things. So what did ETFs unlock for retail in Canada specifically? Well, besides the fact that they could easily purchase it through their iTrade account, right, and hold it with all their other investments and get traditional reports, they don't have to worry at the same time about the stories we hear of losing access to your crypto keys, or am I using the right exchange? Is this a regulated exchange? There's just a lot of uncertainties that are today have become much more clear. But you can imagine when we started working on these products 6+ years ago, that didn't exist. Right? So it's simplified the underlying the complexity of accessing it. It enabled and unlocked opportunities to invest in RRSPs, TFSAs, et cetera. So it really unlocked simple exposure to retail, but it also helped gain exposure to institutions. Now, one would wonder, why does an institution care about an ETF to invest in Bitcoin? Well, you have to think that these large institutions like sovereign funds and pension funds have two worlds. They have an operation compliance world, and then they have an investment portfolio allocation world. And even if the portfolio investment team wants to invest in the asset, it typically has to go through a compliance and governance team. So you could imagine, before the ETFs, there was this sort of dichotomy internally of saying, well, how are we going to custody this? How is governance? Are we going to self-custody? Are we going to go with a qualified custodian? Where are we going to buy this? So all these complexities arose. So ETFs removed all that and enabled compliance and operations to say, oh, it's in a regulated vehicle in a jurisdiction we know and trust. And so now it becomes just an investment decision. And because it's become just an investment decision, we're seeing more and more institutions, some large sovereigns like Mubadala, some pensions in different jurisdictions, including Canada, all have started announcing that they're allocating to the space. So the ETFs simplified access, opened up, registered accounts, and at the same time opened up, or simplified and opened up the opportunities for institutions to allocate to the space.
That really does help connect the dots. Now, before we do go deeper into the crypto ETF specifically, we'll take a step back for a quick refresher. So David, can I ask you, can you walk us through what an ETF is, how it works, and maybe even the different types of exposures that they can provide?
Thank you. So if you think of the origin story of ETFs, they were really a way of having very, very cheap access to things like the TSX and the S&P 500 and the Dow Jones. And that's where most people actually, when they say ETFs, they really think about indices. But I want everybody to kind of think about ETFs as just a wrapper, like a mutual fund. So let's look at the difference between a mutual fund, which many of you probably know what those are, and an ETF. Well, a mutual fund at the basic level is a pool of assets that trades at the end of the day. And that value is reflected at the end of the day at 4 o'clock, give or take 3 o'clock in some places, but all things being equal, it's at the end of the day. Well, an ETF trades every second, every minute, and there's a bid to ask spread, right? What the sellers and the buyers are willing to do. Now, for something to trade all day long you need to have someone kind of figuring out what the value of those assets are. And that's what's interesting. That's what often creates the bid-ask spread. So why do I say that? Because one of the big differences between an ETF and a mutual fund is that the ETF can be traded all day long, but there's market makers that help make the market for that ETF. So once we know that, how does this apply in the world of ETFs and choosing ETFs? Well, ETFs are on a spectrum where we have those very, very cheap, passive type of investments, all the way up to active investments. And those active investments can actually look and feel like a mutual fund, but they trade every day, all day long. And in between, we have things like rules-based, where we're not really tracking an index, but we're tracking certain factors, things like value, dividends, growth. Um, and what you're seeing is a lot of proliferation of a Bitcoin ETF, which is a tracking the price of Bitcoin. That's a lot of the stuff that we've seen in the digital assets. That's the large part, if I'm not mistaken, Pascal. So when we buy an ETF, we want to know what are we really trying to accomplish? Are we trying to get access to a market? Do we like that market? Do we think it's diversified enough? An exchange? Do we want something more active? Or do we want something in between that kind of follows these rules, is a little bit more flexible, somewhere in between? And remember, the more passive you go, the less flexibility you have. The more active you go, the more flexibility you have. So it's the bamboo and the wood in the wind, is the if you know that expression. And that's important for people to understand. The other thing that's really important about ETFs, you can't just put any asset in ETFs. It has to be liquid enough that someone can trade it all day long. That's why you don't see things like real estate in an ETF very often. Private equity or private debt, not very often. They're really hard to make a price on an ongoing basis all day long. So that's the crash course on ETFs. It's really just a vehicle. It doesn't just mean I'm buying an index. It could actually mean I'm buying a very active manager who's adding a lot of value, or something in between.
Thank you, David. That was a really great foundation to set us up with. Now, Pascal, if I turn it back to you, what would be some of the key characteristics that define cryptocurrencies like Bitcoin and Ethereum as an investment asset, and how would their roles differ within the broader digital asset space?
Great question. And this is, again, as we dive deeper in terms of understanding the technology and the asset, and not linking everything as, oh, it's crypto or it's digital assets. They each serve a different purpose. So Bitcoin, of course, was the first blockchain, the first crypto that came out. And you have to think of a blockchain as sort of it's a decentralized ledger. And then basically it tries to serve a purpose. And so Bitcoin was both the first decentralized ledger technology, and at the same time a very clear specific use case. So essentially, it was I like to say it was a monetary policy etched onto blockchain. Right? So we talk about fixed supply, 21 million Bitcoin, et cetera. So the whole concept was to create a monetary policy baked into code, decentralized and protected by the blockchain. And so when you think of etching a monetary policy on a blockchain, what can that enable? Well, it can enable the equivalent of potentially something like digital gold, or digital money transfer, or digital value transfer. And so the goal of Bitcoin was never necessarily to replace the day-to-day spending of the dollar, but it was to create a decentralized digital mechanism of a store of value. And we could debate all day long if it's achieved that or not based on where price action is, but overall the technology was designed to do that. And when we say like digital gold, gold as well, and silver and other precious commodities, where people will treat that as a store of value because it has limited supply, similar to real estate. So any investment that has limited supply, people may see it as a store of value. So again, Bitcoin has it's in the code, 21 million. Over time, as being adopted for different use cases, whether it is to help bank certain individuals in emerging countries, whether it is to help war-torn countries sort of protect assets. When I grew up with a lot of folks here in Ottawa that migrated from different war-torn countries, and their parents had businesses, had homes, and had assets that they couldn't bring with them. So when they came here, yes, they felt safe, but they had to restart from zero, right? So digital assets enable these sort of your hard-earned money and wealth to potentially be saved and stored and transferred with you. So Bitcoin has a lot of value that way. Now, when you look at Ethereum or other sort of programmable blockchains like Solana and others who are designed completely different. So at that point in time, after Bitcoin came out, a lot of Vitalik and other engineers who were like, well, what if we want to build different types of applications or different type of decentralized finance protocols? It's very hard to build on top of Bitcoin. It's not designed to do that. It's not scalable. It's designed to be super robust and fixed supply. So how about we build something that enables any kind of decentralized application or financial application to be built on blockchain? And so that's what Ethereum became, and that's what Solana became, and they all serve different purpose in terms of transaction speed and transaction size, et cetera. But fundamentally what it enables to do is enables you to program different use cases onto a blockchain and then utilize something called a smart contract, but really it's just code with data sources from different parts of the world that says, if this happens, then trigger these conditions. So if David and I were to want to have some form of monetary relationship and not know each other and utilize a smart contract, these platforms enabled to do that. So that's where you're seeing decentralized exchanges, you're seeing decentralized lending platforms. You're even starting to see more and more types of protocols being built on top of that. So when I take a step back and you want to understand what you're investing in, when I went back to, the asset is also the technology, understand that if you invest in Bitcoin, you're investing in some form of digital store of value, digital gold narrative. So if that is something that you're looking to include your portfolio or something that you want to think about, you got to think about Bitcoin that way. If you're bullish, or if you're seeing the trend of saying, I'm hearing a lot about stable coins, I could see a future where AI and agents need some form of digital money transfer. I could totally see the case for tokenized assets and global distribution. Well, those things need to sit on a blockchain, and they tend to sit on blockchains like Ethereum and Solana. So the more you understand the use cases and the more you understand how they work, the more you could build your investment thesis and to see if it makes sense for your risk appetite and your portfolio. But fundamentally, those are the two key differences between when people talk about crypto, right? Bitcoin versus others, you need to understand the use case.
That was a really helpful breakdown. Thank you, Pascal. Now, Pascal, where you'll come in, can you walk us through the crypto ETFs, how they're structured, like spot versus futures based, and even how they differ from direct crypto exposure, and also how they would compare to a more traditional ETF?
Absolutely. How do crypto ETFs function? Very similar to ETFs in general. So when you say traditional ETFs, that's a very big, broad statement, because let's take gold ETFs, for example, because gold ETFs are a little bit different than an equity ETF, right? So how a S&P 500 or a TSX 60 ETF functions is different than how a gold ETF functions. So if you take GLD, for example, it has its gold custodied, right, in an actual vault. And that gold is audited, by auditors, and then basically you have your units of the fund that represent a certain amount of gold, and you could buy and sell the ETF, which essentially gives you spot access to gold. You got to think about crypto ETFs, spot crypto ETFs, very similar. You need a custodian, so you need a qualified crypto-specific custodian. We have those here in Canada. We have those, in many parts of the world, and essentially, many of them are well known. So you need a custodian. But beyond that, the ETFs, on the day-to-day function, works very similar to a traditional ETF. You'll have your market makers, your liquidity providers. You'll have your asset manager that manages the settlement at 4 o'clock, like David mentioned. So they function very similarly. Now, with that being said, if it's not spot, to your point earlier, saying there are derivative type ETFs, which exist as well in traditional finance, you need to understand how derivatives function. So if you're buying into a futures-based ETF, you need to understand how futures roll over and the cost of rolling those over and the impact on performance that they can have. So I'm not going to say that futures are worse or better. You just need to understand how they function, because there is a rollover cost, and that will have an impact over time. Whereas on the spot ETFs, what you need to look at are essentially the how precise can the settlement take place. So essentially, when you're settling your Bitcoin, how accurate are you at the end of the day, and that will be your tracking error. So as a retail investor, that's what you're always looking at for any ETF is tracking error, how close to NAV, et cetera. So understanding that's very similar. Now with that, what we're seeing now is an explosion of innovation that's happening on top of that. This is where the exciting part comes in. Like David was mentioning, there are index-based, but there's also active-based ETFs in traditional finance. And that's starting to take place in crypto as well. And so we're starting to see staking-based ETFs, so basically earning that extra yield on top of your Ethereum or Solana. So that's actively managed. You're starting to see cover call ETFs on Bitcoin ETFs. And you're also starting to see active managed portfolios taking place, right? So originally, it was mostly ETFs around one single asset. You could buy Bitcoin, you could buy Ethereum, you could buy Solana. It was making access to that one technology simple. But now people want more, right? They want the yield, they want the active management, and we're starting to see that into the marketplace. And this is what we ended up doing with Dynamic Funds, right? Was the ETF DXMC, which is designed to be an actively managed portfolio, making it simple to gain access to the fully regulated crypto universe, what we call the picks and shovels. So if you're looking for access to, not sure which blockchain is going to win, but you're looking at having a diversified portfolio of layer one blockchains, and as well access to some of the top companies that are helping build out this space. This is that product. So you're seeing more and more of that, more passive single asset ETFs, more index ETFs coming, and then more active management ETFs. So the same thing you're seeing in TradFi, you're seeing happen in the digital asset world.
Thanks, Pascal. That really helped clarify things, at least for me. I hope for everyone else as well. Now, David, if we bring it back to that portfolio lens, what would be some of the key benefits and also the limitations of using crypto ETFs within that diversified portfolio?
Well, I'll talk about the limitations. I think a lot of the stuff that's available right now is basically Bitcoin access at the cheapest cost possible. So, Bitcoin has its benefits, but of course, it's one of those types of things that inherently there's a huge demand because there is inherent demand through transactions, but there's also a lot of speculation, and that to some extent, not every time, but very often you hear some news about some crypto expert that just dumped all his crypto, or the other way around, and it moves the market, or at least its perception of moving the market. So the first thing I look at is diversification. And a simple way to look at that is correlation. Here's what's interesting about the magic of correlation and diversification. If you take a portfolio and you take something that's very, very volatile, like crypto in terms of standard deviation, which is a measure of risk, which has kind of a low correlation to equities and bonds, and you add it to a portfolio, the magic is it doesn't increase the risk significantly of your portfolio because they kind of move around differently. So first thing I would always look at is correlation. The problem is if you buy a single Bitcoin cheap ETF out there, you only have one part of the whole blockchain story. And as Pascal kind of geniusly said, it's kind of evolved since Bitcoin came out. It's going to be 15, 20 years. You've got all these other platforms, and if you're only doing one type of digital asset, now, and here's what's interesting: there's a lot of talk in moving things like real estate on a blockchain, right? So imagine if you buy a home and you don't have to go through all of the bureaucracy and system. It's decentralized. You can literally transact in minutes with somebody else on a huge asset like a home, good and bad. And futurists are saying that a lot of the assets that we have now, it's kind of like PayPal. We transfer money and assets all the time. A lot of the experts are saying, futurists are saying that a lot of assets that we know today that transact through traditional systems might end up on the blockchain because it's so much easier and the friction costs are much lower. So we look at that, and if you say, okay, well, if I only buy Bitcoin, I might get part of that benefit and that demand. But if I'm not on these other platforms, then I won't have access to that. We're talking about an asset and we want it to go up into the future. And then from a portfolio perspective, if no correlation, there's that diversification magic where when we add it, even if it moves around a lot, it adds value to our portfolio. So I look at correlation between different assets, because you can have something that's very correlated to your equities, as an example. That's what we call beta. That's just more risk. You're not really diversifying, right? You're just really adding more risk to your portfolio, all things being equal. So correlation. The other thing I would look at when you add this to your portfolio, you want to look at your return for the level of risk. Return for risk helps us scale different things we want to put in. Things like gold, right? I would say if you only have a finite amount of money, of course, it's 100% pie. Well, this is better than gold. What's interesting is it's not one or the other over the last 10 years. It's actually both. A smaller allocation to both is actually accretive, which means it's good for your portfolio rather than one versus the other, which is very, very interesting. So I look at it as a move towards the digitization world. Getting in all these different platforms is probably the most diversified way to do it. And overall, that combo is low diversification or lower diversification to our overall traditional portfolio. So it's a net benefit. That's my thesis on it. And that's why I'm pretty surprised I went from skeptic to believer, and I've actually put it in my own personal portfolio after doing all the research on it. So I'm a believer now.
Thank you so much, David. And we've had such a really great discussion so far. And maybe if we start to wrap things up, and maybe we'll focus on a few key takeaways for investors, especially if we're zooming out, how would digital assets potentially fit into some of the broader long-term themes of innovation, diversification, and even the evolution of the financial markets?
Yeah, it's very simple. The world is most likely going to digitize. How are you participate in that demand for these platforms? And Pascal was talking about Ethereum and Bitcoin. That's how you do it. But you also need the right vehicle to manage that complexity for you and evolve through it. Just buying Bitcoin might not give you 100% access of that huge demand that's to come. Remember, the world of the stock market is one thing, but by the way, gold, bonds are much bigger, and real estate around the world is enormously larger than the stock market. Once that these assets start moving to the digital world, can we profit from that by being on these platforms and profiting through the demand of that in the digitized world? That's my thought on it. Pascal might have his own, but that's my thesis on it.
Fully aligned.
Yeah.
No, fully aligned. Yeah.
Perfect. Thank you so much, both of you. This has been a really great conversation and a lot of helpful insights have been shared so far. And I want to thank you again for spending the hour with us. We really appreciate you being here and being a part of the conversation.